My fellow investors, welcome back to the Newcomer Investor Channel, where we talk about great stocks and make investing accessible and fun for everyone. I'm your host, Anthony. Welcome back to the show. Today, I am really thrilled and excited to welcome Aria, who I have been very happy to meet on Twitter and go through all your investing takes. I think you have a lot of energy and a lot of passion and really great takes and great portfolio. So super excited to have you on the show and hear about your stocks. How are you doing today?
Good. Thank you for having me on.
Excellent. Now, before we get started, I should remind everyone that nothing we say is financial advice. Obviously, everyone should do their own research. We're not telling people what to do. We're just sharing what we do. But obviously, we've also made mistakes in our journey of learning to be a better investor. So always do your research. Now, let's get started with a little bit of an intro from you. So if you could tell us a little bit about, who you are, where you're from, how did you get into investing?
Yeah, absolutely. So I'm a little bit on the younger side here. I'm still in university. I do live in Canada, so same thing as you. Um, and in terms of the investing journey, I kind of got pulled in because a very good friend of mine, he's like, General Motors GM. It's trading at like 1.5 times book value. It's undervalued. Blah blah. I didn't know anything about I didn't know the most simple things like what's an asset or anything at the time. I was like 15 at the time, right? And
Okay.
so he kind of reeled me in and brought me into the stock world from there. I made a bunch of very bad investment decisions, and this would roughly be like the 2021-ish period, right? So,
Yep.
um,
Yeah.
yeah, so I would be buying just random things. Oh, AMD, you know what? I like
Oh,
AMD.
yep.
I know about their chips, and then I'd make like 10% in a week and say, oh, this is easy, it's stock thing, whatever. Anyways, we could dive a little bit later into how my investment philosophies evolved over time, but that's kind of how I got reeled in. And then today I follow a very concentrated portfolio. I do follow like mostly a quality strategy, so I'm looking for very wide moat businesses. But then my spin on it a little bit is that I want these businesses to be growing significantly faster than the average of the S&P. So the average of the S&P is growing at, let's just say, around 10%. I want these businesses to sustainably be able to grow their earnings above a 15% clip for multiple years when I'm owning them.
Love it. I mean, hey, that's an excellent strategy. It's hard to lose with that, right?
Yeah.
Very interesting what you said. You started at 15. That's really impressive.
Yeah, it was my
Yeah.
friend, right? So he kind of reeled me
Yeah.
in. Yeah.
No, that's damn. That's epic. Hey, the younger generation. I thought I was young, but this is cool. Okay, and you said you want to beat the S&P, so I guess that wasn't even part of our questions, but do you own the S&P? Like, I don't even know. Do you have any
No,
stocks?
I've never owned the
No.
S&P. No.
Wow. Okay. Oh, wow. All
Yeah.
right. Oh, good strategy. Okay, let's head right into the stocks. Let's start with Mastercard. So you've been tweeting a lot about this business, and this is one that I've looked at a few times, but I never got into it. I don't know why, but yeah, tell me a bit about it. Let's start with the business model. Like, what do they do?
Yeah, absolutely. So, on a very high level, this is, if you're not familiar with MasterCard, which I'm sure many of you are, this isn't the actual credit card company. They at no point issue any debt, none of that. This is simply the connector of my bank account to Chipotle's bank account, my bank account to Walmart's bank account when I go shopping there. It's simply a connector of two different banks. That's how I would describe it. And long story short, because of the market position, because of the decades and decades that they've existed alongside Visa, they kind of serve as what I like to call a tax on all commerce. In essence, if you're going to open your doors to digital payments, you're going to have to open your doors to MasterCard and Visa because 90% of global digital payments are gone through these two. I'm doing rough numbers here, but you guys get the
Yeah.
point. And so it's essentially, it serves as a tax on all commerce, and it really creates a beautiful business model where, and I'm borrowing from the Moody CEO here. He says, your previous sales give you the right to your next sales because they've existed for 40, 50 years and
Hmm.
they've been the default choice for payments around the world. Their previous sales, the past 40, 50 years, gives them the right for consumers today to go out and pay with their MasterCard, pay with their Visa card, and businesses have to accept them all over the world. So it's a very beautiful network effect business model. You could tie in a little bit of scale economies because at the global scale that they're accepted, you could go anywhere in the world. MasterCard is going to be accepted. Right? It's just quality wise, there's a lot of beautiful things to love about it. And then you would imagine, oh, okay, this business has been around for decades and decades, probably doesn't grow that much. You would be completely wrong. They literally wake up in the morning and they probably grow their revenues by about 10% just from
Wow.
CPI. What's
Yep.
it called? just overall prices going up in the
Yep.
world, a couple other things. All these things combined, you're looking at like around 10% revenue growth just from like, again, like population growth, CPI, all that type of stuff. Little bit of organic growth of cash going to digital payments, and you're around 10%. And then they could pull on the buyback lever, another couple percent in there, and margins expand another couple percent, right? Like, so all of a sudden, you have this extremely mature business that's growing around 15% with just essentially doing nothing, right?
Wow.
So very, very
Plus,
beautiful business model.
and I guess also on top of all of that is the percentage of people that are, are alive but that aren't yet doing digital payments. That's still a big chunk of humans, right?
Yeah,
Like
it would
I would say
have
at
to be,
least 10,
right?
20% or something.
Yeah.
So, okay, very interesting. So they are highly profitable. They have the moat as you've established. Valuation wise though, it's like what, 30 times earnings ish, something like that?
So 30 times forward earnings, like 40
Forward.
times
Oh,
trailing
wow.
earnings. So it is expensive, right?
Yeah.
I luckily got in very recently in, I think, either June or July earlier this year. There was a little bit of weakness in the stock. This is a company I've been following for over 2 years,
Yeah,
but
right.
I was always a little bit on the sidelines because of the valuation as well.
Yeah.
But one day I just kind of was like, you know what? Eventually, I'm going to have to overpay slightly just to get in this business. And so there was a little bit of weakness in the stock price in earlier, I think, July of this year, and it traded down to, I think, below a 30 forward PE. It was around like the $430 stock price. So I just got it. I made it around a 10% position. It's done
Okay.
okay since.
Yeah, yeah, no, that's good. Um, Question on competition. So I guess their main competitors are Visa and would it be American Express? Are they the two?
Technically, yeah, American
Yeah.
Express. American Express is one third a bank. So
Right. Yeah, it's a bit. Yeah, it's a
yeah,
little
it's a
odd.
little bit different.
Hmm. What about there must be some in the rest of the world, no? Or is it just the free American one? Is there a big Chinese or Indian one or something?
Yeah. So
Yeah.
globally, exactly. There's a
Oh.
Chinese one, and there is
Oh.
the Indian one. The
Oh.
Indian one is
There
called
you go.
RuPay.
Okay.
The Chinese one, I'm blanking on the name here.
That's okay. But there is
But
what, so I guess, do you see this as a thing again where a bit like, the Amazon versus Alibaba thing where like the Chinese one would kind of dominate Asia and the Mastercard and Visa would dominate the whole, like the Western world, I guess. And they would fight over some other continents like Africa together. Is that
yeah, no,
what you see?
I think they can coexist. I think, I mean, in North American living, and I would assume European living as well, like Visa, Mastercard are just so established. We're like,
Yes.
how could there ever be other possible means of
Can't
payments and that
imagine.
type of stuff? The two big growth geographies for these two moving forward is going to be Latin America and it's going to be Africa. East Asia, Asia Pacific, all that type of stuff, there's a little bit more increased competition, and particularly the governments don't really want, for
Yeah,
example,
yeah.
China, like they don't really want Visa
Yep.
to have that much power in their own borders.
Yep.
And actually, I think PayPal, funnily enough, is the only company that wholly owns its subsidiary inside China. So like
Oh,
Visa's not able to, Mastercard's not able to. Weird how that works, but the point is like I don't think those governments would really want Visa to be, or Visa or Mastercard to be, that powerful in their own borders. And it does get a little bit scary of like, okay, if this works in China and they're totally able to cut out Visa and Mastercard, or for the most part cut them out, what happens if all of a sudden the Chinese equivalent of what's it called, Visa, decides to, you know what, let's go to Singapore, let's go try it out in
mm,
Thailand, and all that type of stuff, right? And what's interesting is if actually a Chinese citizen goes to, for example, Thailand or Singapore, some of these other nearby countries, it actually gets routed through Visa. So they have that
oh,
partnership made there,
okay.
where if it's a cross-border transaction, Visa would still take a cut. Of course, I'd imagine it's not the same cut that, for example, a American citizen going to Canada or vice versa. But nonetheless, like Visa is still involved there.
Okay, interesting. And so, if I can ask, why do you own Mastercard over Visa and AXP? Why not just own the three of them together?
Some people take the basket approach. It does work well. When we're investing in concentrated bets, ideally you just want one company that shares its own individual risk factors. Of course, for example, like I'll just spoil the portfolio a little bit here. I do own, for example, Amazon and Google, which have a good amount of overlap on
Yeah.
various parts of their business. Maybe,
Hmm.
I don't know, give or take
Cloud
30-ish
ads.
percent or more overlap. But nonetheless, when you're making concentrated bets into these businesses, you don't want to own like essentially the same company, but in two, right? So I don't want
Right.
to be owning 10% Visa, 10% Mastercard. A lot of super investors, even, they take the basket approach. It works out perfectly fine. Me particularly, the reason I chose Mastercard over Visa, it wasn't even a competition with American Express. I've never hard looked at that one.
Mhm.
The reason I chose Mastercard over Visa, though, it grows slightly faster in the slightly higher valuation at the time, made up for the fact that it is growing faster, right? So at the
Okay.
time, it was growing around 16% free cash flows, and it was like 30 times price to free cash flow. If you do the comparison with Visa, it made sense to go for Mastercard.
Got it. Okay, very dumb question, but I still have to ask. I'm just curious your take on that. Though I think I probably know. Is what do you think of all the people who say, crypto is coming and is going to disrupt everything with the payments systems and all of that? What do you think of that? Maybe not for next year or two, but next like 10 years or more than that.
Listen, I'm not going to tell you it's not possible. I don't know how any of this stuff works, and the hard part of investing, I personally battle with this a lot, is the unforeseen risk factors,
Hmm.
right? Like if you're sitting atop Internet Explorer in 2004, and then Google comes along all of a sudden, like that is the
That's true.
unforeseen. Like within 2-3 years that happened, right? So
Yeah, yeah.
it's the unforeseen risk factors that really eat me up at night. So again, I'm not going to tell you like the crypto thing can't happen. It's going to take over all digital payments, whatever the case is. My only issue is, and maybe not even with crypto, but with any new form of payment, what is the incentive for me to pay with crypto compared to me paying with my credit card that I absolutely love, that I get a 1% cash back at the end of the month? And
Yep.
I had a very lengthy debate with someone, and they were saying, oh, well, they would create the same thing. They would give you a 1% cash back. Okay, what's my incentive to switch to crypto? I went through this arduous process of getting my credit card, and it's defaulted in my life, and I constantly carry it with me everywhere. What is my incentive to switch to your crypto? Okay, well, then they would pay 1.5% cash back. Well, you're just kind of reinventing the wheel here, right?
Yeah.
Like you're kind of creating the same thing at that point. So it's Visa and Mastercard, ultimately like the moat, network effects, whatever, whatever. But if you really think about it, it's a masterclass on incentive alignment. The
Yeah.
incentive of me, the consumer, is aligned with the bank who ends up making 1%. With the at the end of the day, like sure, the business is also like kind of complaining that like, oh, I have to pay this 2-3%. But at the end of the day, it's in their best interest to accept digital payments because they don't have to carry the risk of cash in person in the stores getting robbed, maybe some of your employees stealing that cash. So
Hmm.
all these different things, it's easier to do taxes with, all that type of stuff. So the incentive of alignment of all five parties involved with the Visa MasterCard ecosystem, that's ultimately the moat. And I would
Yeah.
question that incentive alignment with crypto.
Yeah, yeah, yeah. No, very, very fair take. And I agree. I think it's probably among the greatest moats in the world. That whole ecosystem. It's hard. It's hard to. For me personally, I would say I don't think crypto is gonna disrupt in the next 10 years. To be honest, I think Mastercard will still be there in 2035.
I'm
Um,
investing my dollars that way as well. So
yeah,
yeah, I
yeah,
agree.
yeah, yeah. Okay, let's move on to another one. So this is the one that I honestly, when I saw you tweeting a lot of stuff, that was the one where I was like, I need to talk to you about this because I just don't totally understand. I haven't researched it much, but ASML, just please tell us what did they do? What is
Yeah,
this, and why is it good, and why should people be buying?
yeah, absolutely. So to kind of give you a frame of reference, this is a $300 billion market cap company. It is one of the biggest companies in the world, and it's there for a very good reason. Long story short, all the chips and like you hear about these Nvidia chips, Apple's making their own chips,
Yep.
Amazon's making their own chips. All these chips being made, these are very advanced, complex chips, and so it needs a company to come in there to be able to build the machines that end up printing these chips. To kind of give you an analogy of like for it to make a little bit more sense, this would be like if you're in the process of making a cake, this would be the blender, right? The blender is a pretty
Okay.
important
Yep.
piece to this entire thing, right? So ASML essentially makes the blender that is able to enable the making the cake or making the chips in this case.
Yep.
And this is the only company that is able to make the leading edge machines, right? So they're
Oh
called
wow.
EUV machines,
Yep.
and on like a large scale, all these machines they're under the category lithography machines. So
Yep.
ASML is the only one that makes EUV lithography machines, and those are the ones that are made to make the leading edge NVIDIA, the AI chips, and the Apple chips, all that type of stuff. Now, the other part of the business, which makes up for like most of the revenues, is DUV. DUV is like simple chips that go into, for example, like car batteries or like, sorry, not car batteries, like car components and like
Okay.
the toaster or like the fridge. All these things have chips, but they're very basic chips. The
Yep.
calculator, for example, it's not really doing too
Simple
many
chips.
complex math, right?
Yep.
So ASML's business pretty much is they make these machines that are very expensive. They cost hundreds of millions of dollars, and they're
Each.
essentially necessary
Oh.
to just global chip manufacturing.
And does no one else in the world know how to make those machines like at that level? Are they the only one?
The EUV machines, so the
Yeah,
very
the
complex
UV. Yeah,
machines,
yeah.
they are essentially impossible to make. I mean, it's
Oh,
pushing the edge of known physics, quite literally.
wow.
So, and the idea is like they're like shooting lights at like tiny pieces of silicon that are like a fraction of like a human hair thin, right?
Hmm.
And you have to do it like 50 times per second in order to
Wow.
print these designs on it, right? Like it's just very incredible physics at play here, right?
Yeah. Okay. And again, I'm asking because I really don't know about this, right?
Yeah.
What can you imagine? Okay, if someone else, let's say in China, because China's pouring hundreds of millions into science and research, let's say China makes their own version of ASML. How does that impact the markets? Is this the type of thing where I guess because is it like a strategic asset where like in the US they would never buy the Chinese version of those machines, or is it something like a commodity where people will just buy from whoever at the lower price?
Yeah, yeah. So there's two things going on at play there. I mean, in theory, based off how capitalism laws work, that should be how it works. Eventually, China's going to figure it out. They're going to come into the market. They're going to undercut ASML, and they're going to take market share. That's how it should work, right? There's a very slight problem to that. Number one, ASML has kind of cultivated these relationships. They have three main customers that account for, I think, about 80% of revenues.
Oh wow.
Samsung,
Yeah.
Intel, and TSM, which is the biggest
Taiwan.
customer,
Yeah.
the newest $1 trillion company.
Yeah.
So TSM alone accounts for about half of revenues. And so they
Okay.
have these
Yeah.
three customers that they're selling to. And it's the problem is, even let's just say China had just as good as a system, maybe even a better system. These are big factories. It's not as simple of TSM's going to walk over to China and say, "Oh, okay, this machine, whatever, great. Let's just grab the old ASML one out of the factory and then toss it
Right.
to the side, and it
Yeah.
perfectly fits inside whatever the case is, right? Like, it's not as simple as like they're not interchangeable parts. Like
Yep.
you can't just take one out, put the other one in replacement of it, and nothing's going to get messed up, right?
Right. It's massive
Um,
commitments.
so like the factory itself is like specifically built in a way to fit the ASML machine and fit the ASML process. That's
Mhm.
one thing. Number two, ASML in particular, in I want to say 2012, this is the biggest part of ASML's moat, by the way. Like this is personally, I when I heard this, it like pushed me the extra mile to start investing in the company.
Mhm.
In 2012, EUV wasn't a thing. So the leading edge machines, they weren't a thing. Like in theory, they were a thing. They were researching it, blah, blah, blah. The machines weren't actually out yet. And so they brought all the key customers in, namely Intel, Samsung, and TSM. I'm
TSM.
going to refer to them as foundries from now on, just for,
Sure.
yeah. So they brought all the foundries together and they said, hey, we don't have the money to continue researching this EUV technology. We would like you guys to invest into our company. And they did. They invested about 24%
Ah.
into ASML, right?
Yeah.
We'd like to
Okay.
invest into the company. So you're
We're aligned.
incentives are aligned with us, and we're
Mhm.
going to create this technology. We know it's going to eventually benefit your business. We don't have the capital to do it, so we'd like to seek your capital. In return, you can own a part of the business, right? And know that we're going to
Okay.
eventually sell to you and that type of stuff. What's
Yeah.
interesting about that is Intel was the first to invest in ASML, and they didn't ask for the EUV technology to be exclusive to them,
Oh,
which
why?
is, I don't know, they didn't negotiate it, which is just
Damn.
that's the one
They're
part that
probably
baffles
punching
me.
the air now.
Yeah, in the entire story, I
Yeah.
don't understand.
Oh,
Anyways, so
yeah.
to give you a timeline, they did that
Yeah.
eventually with the $4 or $5 billion of capital that they got. They were able to make the EUV technology, and in the process, this is the fun part about it. In the process, you're essentially like these are some items that you can't just buy off the shelf. This isn't like a battery that you go to Home Depot to get.
Yeah, right. Yeah.
These are specifically made to fit into the machine, and there's like a
Okay.
100,000 parts that goes into each ASML machine,
Mhm.
and so ASML themselves would have to create a bunch of these. With that being said, 90% of the parts that go into the ASML machine, ASML doesn't actually make themselves. They simply assemble it from a long list of suppliers, right?
Okay.
And with that long list of suppliers, over time, they're like, oh, you know what? This one company that makes, for example, the light source inside the machine, this company, like we're the entire business for this company. Why don't we just buy them? Right? Strategic acquisition.
Mhm.
So
Yeah.
when you want to go make a lithography machine today, you kind of can't because the company that used to make the lights for everybody else is wholly owned by ASML. It's in the best
Okay.
interest of ASML to not sell you that light.
Mhm.
So again, going all the way back to your China question,
Yeah.
if they were to try
They're
to
gonna have a
kind of
hard
get
ass
into this
time to
market,
do that.
sorry,
They're gonna have a hard ass time to do that.
they're
Yeah.
going to have a impossible time trying to create
Mhm.
the light, let alone the other 100,000 parts that goes in the lithography machine.
Interesting. Oh, so that's like the ultimate moat, basically. That's
The
crazy.
ultimate technological moat, yes.
Yeah. Oh, damn. Okay. Wow.
And just very quickly, for
Yeah.
any other listeners, if you have access to the Morningstar reports through your brokerage, I know Interactive Brokers has it, Robinhood has it. Please go ahead and read the ASML report. It's maybe 30, it's the most worthwhile 30 minutes you'll have as an investor. I could not recommend it more.
Mm-hmm. Okay, I'll definitely be checking that out. That's very interesting. Okay, let's look at recent earnings. I know there's been a lot of chatter. I think it fell a little bit. So, like, there were a report that people didn't like, or yeah, what happened?
Yeah, so
And you
I do
bought
want to
more, I
just
think,
plug.
right? You bought more
Sorry?
when that happened. You added to it.
Oh yeah, yeah.
Yeah, yeah,
So
you did. Okay. Yeah.
I've tripled my position in the past 2 weeks. So there was
Wow.
weakness prior to the earnings, which I bought a little bit, and then I bought after the earnings. It now accounts for about 8% of the portfolio. I would like to probably add more in the future, call it a couple of weeks. I do want to just shout out my most recent video that just came out. I do cover it pretty good there. So in case I miss any details, like there's a
Mhm.
good amount of information there. Long story short, with the earnings, it was a massive um, fear, I guess you could say, of there's a key performance indicator, KPI, that ASML tracks. It is called the net bookings number. So it's essentially like all the contracted ASML machines that they've sold. That is like we're expected to get revenue. It's essentially like a account receivable, but for like the next couple quarters, right?
Okay.
And there's like a specific KPI that they track of like, yeah, like these the Intel or whatever is like contractually obligated to pay us for this machine. It's just on the books. It hasn't gone through, whatever, right? You would imagine if you're selling a $200 million machine, the sales cycle would be pretty long. You know what I mean?
Right.
So,
Yes.
anyways, so that number missed by about 50%. It was expected to be
Oh,
5 and something. It came in at like 2.5, right?
okay.
So that was ultimately like the big scare. It's kind of funny how it came out because it came out a day early on accident. I don't know if you did
On
you catch that?
accident? I heard some chatter about it, but I didn't pay it like on accident though. What does that mean? Like someone leaked it like they shouldn't have type of thing?
No, on their own website, the earnings came out a day earlier, just completely on accident, and then it got quickly taken down. But like
Oh.
Bloomberg
Oh.
downloaded all the information, I'd assume, and like
Oh.
they
Okay.
put it in an article. Yeah.
Someone's
So
getting
anyways,
fired.
sorry.
Someone's getting fired.
Yeah, definitely. Yeah.
Okay.
Anyway, that was ultimately the big fear. And then another thing that I kind of saw getting floated around on Twitter, um, some people were saying, "Oh, look at the China revenue as a percentage of total revenue. It's starting to increase. A couple of years ago, it was 15%. Now it's 50, right, on a quarterly basis." But then if you go into the earnings call, they literally point that out. They're like, "Yeah, because we are seeing some hesitancy with our big customers, aka all the foundries." And they're a little bit more hesitant and like they're waiting a couple quarters on the next sales cycle and that type of stuff. We are seeing a spike in China revenue because that intuitively that makes sense.
Yes.
If the China revenue is just staying as it is, but then your total revenues are declining as a percentage, that's going to increase,
Yep, that
right?
makes sense. Mhm.
Totally makes sense. And then an analyst specifically asked them, saying, what do you foresee in the future? Whatever. They're like, yeah, it's about 50% right now, but we think in the next couple of years we expect it to be in the low 20s, which is where
Okay.
it's been historically. Completely makes sense, right? So
Yep. That's
that
very
argument I
reasonable.
just completely write off. I think it's a super temporary, literally just the past couple of quarters issue. I just would not even think about that. The net
But
bookings
also,
number is a
wait,
real.
sorry. Just want to stop you right there. But even if it was 50% from China, like, what is the issue with that? Is it just again, it's like, oh, communist country type of thing? Is that what they're worried about,
Okay,
or
yeah,
what's the
sorry, I should
problem?
explain that.
Yeah,
Yeah, so
because money is
the
money, regardless of where it comes from.
yeah,
But yeah.
historically the China issue has been, even though it's a Dutch company, maybe I should have mentioned that up front.
Hmm.
It's this
Yeah.
company's headquartered in the Netherlands, although it is listed in on the Nasdaq in the US, right? Historically, the issue with a lot of China revenue, particularly in the semis industry, and even Nvidia saw this, I think, in 2022. There has been, and there could be future regulations passed, essentially saying that we don't want you to sell this technology to China because we don't want to make that geography more powerful than the US,
Ah, okay.
right?
So geopolitics. Okay. Yeah.
Geopolitics. Now, the issue with that is, sure, the leading edge EUV machines and all that type of stuff, they've been banned from being sold to China for like a long time. But then the current machines that are being sent to China, and I believe this is SK Hynix, the main company that buys it in China, the machines that are being sent to essentially SK Hynix, those are all like very basic DUV machines that are like even
Got it.
Nikon and Canon can make them.
Oh,
It's used
okay.
to like make calculators and all that
Yep.
type of stuff. So even if let's just say that part of the business made 50% of revenues, it's not prone to any type of regulation. These are
Mm.
very basic machines.
So it's just analysts being scared. Like again, people just getting a
Yeah,
little
I completely write off the China
overexcited.
risk argument.
Yeah. Okay. Okay. I see. Ah,
Yeah.
interesting. Okay. And sorry, so I cut you off, and then you were going to talk about the bookings.
Yeah, so then the net bookings is a real maybe like negative catalyst for the next, call it, couple quarters to up to a year. It was, and you could see this on the revenue chart of ASML. It's very cyclical, by the way. So you would see that like for give or take 4 years, the revenues are like somewhat flat, slightly up, slightly down, and then within a year the revenues double. Why is that? There's a new wave of technology roughly every 4 years, and all these key customers of ASML, they all kind of put their orders in roughly within the same year. And like there's like a big pipeline, even internally at the company. I've spoke to some employees that are like, yeah, like we're looking at 2025. We're looking towards 2025, right? So for the longest time, internally within the company, on all the conference call materials, that type of stuff, they're just focused in on this one key year where they're going to mass make all these different UV machines.
Hmm.
Essentially, what they said in the most recent earnings call, they talked about how this customer cautiousness is kind of pushing back their timeline of when they expect to be selling all these UV machines. And so if we expected it to be 2025, maybe now we expect that big boost in revenue, the 50% gain, like literally overnight. Maybe we expect that a little bit later into the year 2025. Maybe we expect it earlier in 2026. That's what I got out of the net bookings number being down.
Okay. So it's just a deferral, but it's not like a permanent impairment of the company's abilities to make
No,
any revenues or profits. Then.
no,
Yeah.
it's just a delaying in when the next wave of revenue is coming.
Yeah. And I guess within that delay, the moat is still the same. Like it's not going to change anytime soon. So it's perhaps an opportunity then, because it fell like what 17% or something in a day.
It fell 22% in 2 days.
Oh man, yeah. Okay, huh, interesting. Maybe I should look into that too. I have a little bit of exposure via a world ETF. I wanted a world ETF because I get access to all the best European businesses and best Asian businesses too. But cool. Okay. What else would you have to say about ASML, if anything, that listeners should be aware of?
We'll touch on valuation here. And historically, me personally, I've put the utmost importance on free cash flows. Now, I've done a pretty detailed video talking about how free cash flows are actually very misleading depending on where the
Hmm.
business is in the capex cycle. Free
Yeah.
cash flows essentially rewards the capital light business that is extremely mature and doesn't have a lot of variability in their cost.
Yep.
I'm describing to you Mastercard's business model, right?
Hmm.
Other than Mastercard, like in general, free cash flow isn't the best immediate measure of value. And there could be a lot of variables and a lot of swings in how the free cash flows are, depending on the capex cycle, all that type of stuff.
Yep.
In ASML in particular, which is a somewhat capital heavy business, not really, again, because they bring 90% of the parts that go into the lithography machines, they bring that they're essentially like an assembly company.
Hmm.
You could kind of think of it as like Boeing. Like Boeing doesn't really manufacture anything for themselves. They kind of
Yep.
just assemble all the parts and sell it.
Yep. Yep.
ASML operates in a similar manner. And so free cash flows historically, depending on the how the inventories look and all that type of stuff, where in the cycle they are, free cash flow hasn't been that good or like that great of a method to look at it. And then in terms of PE and that type of stuff, that's how I like to evaluate. That also is comes with a big grain of salt because if you're looking at like trailing PE when the earnings and the revenues are depressed, it might look excessively expensive, right?
Right.
You're looking at
Right.
like, oh, 50 times earnings. Are you? Why
Hmm.
would we invest in this? They're way too expensive. I don't care what the mode is, what the earnings are, whatever. But then if you look on a forward basis, you're like, oh, how is it going from a 50 trailing PE to a 23 forward PE? That's the whole
Hmm.
discrepancy I'm talking to you
Yeah.
about the cyclicality of it. So it's
Yeah.
a
Yeah.
very difficult to value business. Nonetheless, the forward PE of the company, it sits around like a mid 20s PE, which for like around 20% long-term earnings growth rate plus the moat plus it has very good margins. Like
Yeah.
it's
It's
like a
quite
50 something.
reasonable. It's reasonable valuation at
I
that
think
point.
it's a very reasonable valuation. Yeah.
Yeah. Okay, thank you for that. Awesome to hear about ASML. Great business. Let's move on to Salesforce
Oh boy.
CRM. That's like one of your favorites, right,
Oh
dude?
my God.
Yeah.
Absolutely love it. So this is a bit of a difficult one as well. Like obviously when like we talk about like Amazon, it's very easy for you to picture, oh, okay, what Amazon is, why the business is good, or like Costco or any of these other like consumer facing companies. When you dive into the world of business to business companies, it takes a lot more research and like actively thinking about it and like why this would be powerful. In the case of Salesforce, they sell a very sticky software known as a customer relationship management software. And that's the same as the ticker, by the way, CRM. So kind of cool
CRM.
they have that. Um, Essentially, what a CRM is, I'd like you to think of it as like kind of any information that a business would have on a customer, they would be able to store it in that. So if you were to think every time you fill out, like if you go to Disney, right? If you go to Disney Plus and you fill out your information and you put your name in there, your address, your email, all that type of stuff, they're able to store that somewhere in Salesforce, right? Like this is a software on the web that they're able to store that information on. And then the next time Disney is like, doing an event in Toronto, very easily they'll be able to see, oh, okay, based off this person's address, they live in Toronto. We're doing this Disney event in Toronto. Let's send a mass marketing email to everybody in Toronto saying, oh, we have this event about Disney, come look at it, or whatever the case is, right? So it's a customer relationship management software, and you're able to do a lot of fun things with all the information that you have on your customers based off that information, like when to send them emails. And I want you to think of like the use case of like in a bank. Like when you go to fill out your banking information, when you sign up for a credit card or whatever the case is, that's a lot of personal information that you're putting in their hands. And based off that information, let's just say at a certain age, again, they have that automated marketing email set up where they're going to send you in and they're going to say, oh, check out this 4.6% APY high yield savings account, right? And so they're kind of able to cultivate this relationship with you, the customer, based off all the data they have stored in Salesforce. So that's the general explanation of what it is. I'm not sure I'm making sense
Okay.
there.
Yeah, no, you are. So they just sell this software to other businesses, like I guess thousands and thousands of businesses, and then they use it for their purposes with their customers, and it
Yeah.
helps them
So
optimize the relationship
for the businesses to optimize the relationship with their
with the
customers. Yeah.
customers. Yeah,
Yeah.
yeah.
Absolutely.
Okay.
So
What does the like? What's the moat in that? Are there others? I think there are others who do that, right? Like, doesn't
yeah.
SAP do a
So
version of that?
absolutely. So they have about 20, I think 2% market share, and they have more market share than the next four competitors combined.
Oh, okay. So they're
So
the premier, the number one for sure.
by far and away, it's the standard. If you ever go to sign up for any type of sales or customer service job, very often, like how like in some in some resumes they're like, yeah, proficient in Excel.
Oh,
Like
yeah.
it's kind of like the same network effect there, where it's like if you know how to use Salesforce, it's actually very powerful for your resume,
Yeah.
that type of stuff. Like it's
I
very a
have seen
very
that.
common thing. Yeah,
Yeah.
and you could actually kind of think of it similar to Excel in that sense. Like it kind of has a similar attributes and that type of stuff. It's just the standard, and everybody recognizes it's the standard. That type of stuff. Sorry, your question was
Yeah, competition. Like, who are the others doing
yeah,
this?
competition. Microsoft is a good second place. They have about 6% market share. Other than that, it actually gets a little bit weird. It goes like Adobe, SAP, Oracle, and then what's it called?
Adobe?
Salesforce is only enterprise. So on the small to medium sized businesses, like you're thinking, I don't know, like the local restaurant, they're not going to be really using Salesforce. They would probably do something like QuickBooks and that
Hmm.
type of stuff, or like any like small business where they're doing like a couple $1 million in sales per year. They're not going to spend like tens of thousands on a Salesforce system. They would probably be opting in for like again something like QuickBooks or like Monday.com or some of these other like smaller softwares, that type of stuff.
Okay, so now given that we're in the world of software, am I right to assume that it's probably a very high margin business? Like they don't have crazy capex and all that stuff, right? So it's very profitable.
Yeah. So the capex part, interesting. As of very recent, they stopped doing their own data servers, and they're fully going towards AWS. All the incremental,
Oh, okay.
uh, yeah, all the incremental IT is going to be on AWS. So very very fun that you brought that up. So they are moving towards being very capital light, and they are. I think like 90% of free cash flows, or sorry, 90% of free cash flows are operating cash flow, right? So about
Wow.
10%
Okay.
margin in the
Yeah,
middle
yeah,
there.
yeah, yeah.
They have 80% gross margins. So you'd be right in assuming it's a software business, right? Like
Yep.
And then their operating margins have expanded from 0 to 20% in the past 18 months, and it's trending in the right direction. So overall margin structure, very good business.
Sorry. Why was it zero?
They ran like that to kind of at like essentially break even costs for a decade just to kind of expand their market share.
Oh,
If
okay.
if you
Makes
go
sense.
back, I think in 2012, 2013, it was very even actually between Salesforce, Oracle, and SAP. They all had about 10, 12% market share. So they've kind of ran at this pace for like a decade. And then recently they hit the profitability button.
Okay. How do you view future catalysts or just the future of that industry? I guess again, is it a type of thing as the world digitalizes more, there'll just be more businesses buying their software? Is that kind of how you look at it?
So I guess, yeah, you could look at it that way. The way that I know it will grow. So maybe we should touch on the moat first, because this would kind of
Mm,
help explain that
sure.
part of the thing. So naturally, and I've given the Apple ecosystem example of like you bought the iPhone a decade ago, now you have
Hmm.
five
You're
different
stuck.
items,
Yeah.
right? And if you don't think that's an appropriate example, it is absolutely an appropriate example because Mark Benioff, the CEO and founder, and still is the CEO of the company, he worked for Steve Jobs. He interned for Steve Jobs 30, 40 years ago, and he constantly had meetings. They were very good friends. They constantly had meetings. So you could see a lot of similarities the way Steve ran Apple and Salesforce is run by Mark Benioff. There's a lot of similarities there, right? And so the same switching costs, if you will, of me buying the iPhone a decade ago, and now I have five different, and I will never switch off of Apple products. The same thing kind of applies to Salesforce, where a small bank 10 years ago, they adopted the Salesforce system. And then over time, they started putting all their customer information in for the past decade. All their stuff is in there. They ran so many marketing emails and programs and all that type of stuff. And then over time, Salesforce is like, oh, you know what? You have this, you have that. What about you go for a customer service software? Or what about you go for this other software that we're able to kind of cross sell you on and all that type of stuff? And oh, your team members, they're trying to communicate with each other on email. We own Slack, actually. Did you want for us to sell you Slack? Right. So all this cross selling over the past decade has occurred, similar to how Apple did it with me with the iPhone, and I got AirPods, a MacBook, and whatever,
Yeah.
whatever. And so ultimately, the switching costs after a decade becomes too incredibly high for you to switch off of the
Yeah,
ecosystem.
yeah.
And
Oh
so,
man, I love that comparison. I am like you. I'm stuck with the like. Here's my iPhone. I'm stuck with Apple since forever,
yeah,
and it's very powerful. And also, touching on the fact that a lot of companies, like the customers, right? We don't like change. Like you have all the employees within. Maybe you'll have one person in the IT department who's like, "Hey, I found this other company that has a software that's slightly cheaper or better or whatever." But they have to convince all the employees in the company. And I can tell you, man, the politics in big corporations, right? It's like sometimes it's ridiculous.
yeah,
They can't convince everyone else to switch because they'll be like, it's too complicated, it's too much work, and all that. It's gonna be right, and so they get stuck. So
yeah.
that's a
So
very good analogy.
why would you fix something that's not broken? You know what I mean? And
Yeah,
even in the case of that one IT person, sure, it's cheaper, sure, it's whatever. Have you considered the data migration costs? We have a decade's worth
yeah,
of information that we have to move. And I actually have real numbers from a real business that, like, I was told not to,
yeah,
like give names or whatever.
sure,
Like, you would recognize this company by name. And
yep.
in the past couple of years, they switched off of Salesforce. And in the process of switching, net everything, net paying the people to migrate your data, all that type of stuff, they paid $56 million to save about $16 million.
Oh man,
So, like, the math of that doesn't, and
yeah,
in the process, you're moving to an inferior system, not to mention all your salespeople and your service people and all that type of stuff. They're moving to a new system. The 50-year-old, I think of my dad, for example, right? Like, my dad, he's not going to be able to switch to a new software just like that. So,
hmm,
when, like, these people that are like 40, 50, 60 years old, maybe they're not too technologically inclined after a decade of like using the software and getting used to it. Oh, when I click this menu, this thing pops up. That's where I go to do that, right? The switching costs of going to a completely new system and having to learn it all over again. You know how many countless hours of inefficient employee hours they just bought for themselves in that process?
hmm.
So again, like you could kind of think of it as like after being on the iPhone for so long, going over to like the Google phone or like going to the Samsung phone, and like you don't know where anything is. You know what I mean?
Yeah, it's just not worth it.
Yeah.
I think you were the one, correct me if I'm wrong, but you had tweeted about stock-based compensation, I think, at some point about sales. And you said that it's getting better now. They used to have a lot. It was kind of crazy, and now it's okay.
Yeah. So
Yeah.
historically, stock-based comp has made about half of free cash flows. In the trailing 12 months, it is about 25%, which is better than
Hmm.
what Google is.
Wow.
So they've completely just outdone themselves. They've completely changed the business. It's actually on a downtrend. So it's continuing to
Hmm.
actually go down quarter over quarter, all that type of stuff.
And is that due to them again, like just making their own moves to be more shareholder friendly? I guess.
Yeah.
Crazy
Yeah.
stuff.
So about 2 years ago, in the peak of 2022 bonanza, basically, they had actually, I think, five, take five with a grain of salt. They had five shareholder activists that bought shares into the company. Really, only two of them kind of worked together to essentially make it more shareholder friendly. They stopped diluting for one thing. They slowed the pace of stock based compensation. They started doing more buybacks. They do about 2-3% buybacks per year, which is again like in the ballpark of like someone like Google.
Yeah.
They newly issued a dividend about 2 quarters ago, and yeah, overall just very shareholder friendly since then.
Wait, they have a dividend.
They have a dividend
Oh, okay. So they did like Google and Meta and all these other tech
right before
bros
them
all at the
actually.
same time. Yeah. Yeah. Oh, before them. Interesting. Okay. Anything else you want to mention about Salesforce? Seems like there's a lot. Oh,
Um,
valuation, actually. How, yeah, is it a buy now, do you think?
Yeah, so if you adjust out stock-based comp, it's about like a 3 and a little bit% stock-based comp adjusted free cash flow yield. That's quite a mouthful. So I think that's a very appropriate price for a business that's growing in the high teens to maybe 20% free cash flow growth rate for the next, call it 3, 4-ish years. Revenue growth is a bit of a question mark. The past year, it's actually slowed down to about 8%, and that's a very big hit on Salesforce. Like a lot of people complain about that. If you look in Salesforce, similar to like the net bookings thing for
Mm. Yep.
ASML earlier, this is also like a KPI that Salesforce tracks. It essentially shows the pipeline, like the contractually obligated revenue in the pipeline for the next 12 to 36 months. It's called TRPO, total remaining performance obligations. And so Salesforce tracks that. That has been growing at about 15% the past couple quarters and past year, give or take. So sure, revenue growth is about 8%, but contractually obligated revenue is growing at 15. I would expect these two to kind of meet each other within the next, call it 3 to 6 quarters.
Great. Okay. Well, overall, very bullish take, I think, then on Salesforce. Yeah, you're pretty confident in that one for the next
Very
few
confident.
years. Yeah.
Can I just one last thing
Yeah,
to touch on
please.
here?
Absolutely.
With Salesforce, and again, the switching costs of after like a decade, their top clients that account, I think 20% of customers account for 80% of revenue. That
Wow.
cohort,
Uh-huh.
that cohort of 20% customers, they will never switch off of Salesforce because they have like four different modules of Salesforce and all. It's just,
Hmm.
it's essentially become like the veins of the
Yes.
entire organization, right? Like you'll never be able to switch off, even if you do. Like you're incurring hundreds of millions of dollars in terms of costs just to get off of the system and to an inferior system. And again, the headache of all your employees having to relearn it. So the amazing thing about Salesforce is that they have that like backbone essentially of these customers that will never switch off. So you're not going to see variability in terms of the revenue and the profits and all that type of stuff. And then on top of that, for the past 20 years, Salesforce never raised their prices ever. And then a year and a half ago, they raised prices by about 10% for the first time ever. I would expect, and earlier you asked about how do you think of the future growth of this business? I would expect a mix of just organic, these organizations, because they charge per employee. So
Ah,
or
okay. Yes. So they grow the economy.
organizations
Good.
as they increase in terms of headcount,
Hmm.
Salesforce is going to grow alongside them. What are you going to do? The next salesperson you hire, you're not going to get them Salesforce. How does that work? Right. So
Right.
over time, that starts to increase, and that's one way Salesforce is able to grow. And then the second way they're able to increase revenues and that type of stuff is they're going to be able to increase prices over time.
Makes sense. Okay. Love it. All right. Let us move on to, well, stay within tech. I want to hear your thoughts on Amazon. I think that is your largest holding, right? Or it's among your
Yes,
largest.
yes.
Yeah.
So
Okay. Let's hear the whole thesis on Amazon. And I'm specifically interested in hearing your thoughts too about potentially splitting the pieces, like the, sum of value of the parts, like all that kind of stuff. How the valuation could be at that point.
oh, okay, I see what
Yeah.
you mean.
Yeah, yeah,
Yeah,
yeah.
I thought you were saying maybe we should split the company apart. I'm like,
No, 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 no. I'm sorry. I'm not explaining what. You know what I mean, though.
Yeah, I
Or
got you. I got you.
yes,
Some of the parts valuation. So,
exactly.
in terms of Amazon, this is actually the longest held holding of mine. This is the only company that I've held since I kind of I did the purge in my portfolio. I got rid of everything. Like
Yep.
at some point, I owned Tesla, which I got
Oh,
out with like just barely, essentially a break even profit, slightly in the green. This is the only company I've held since 2022, and I expect to hold it. I'd probably pass this on to my kids, right? Amazon, I don't need to pitch you on like why it's such an incredible business. I think everybody understands that.
yes.
Um, and it accounts for about 30, 31% of the portfolio.
Wow.
Long story short, the one part for me that like it's completely core to my thesis, if we see any type of like slowdown or any type of weakness in this part of the business, this would be my catalyst to sell out of the business. It is the cloud part of the business, right? I think everybody kind of understands. Um, Essentially, anything you do in the world is done through the cloud, through a web browser, all that type of stuff. And Amazon sells the infrastructure to the cloud in the world. They're the biggest in doing that. They're about 30% of that market compared to about 20%. I think Microsoft is second, and then like 10% Google, all that type of stuff.
Yep.
If you want like a very detailed explanation of essentially why cloud is powerful, I recommend the podcast. Maybe we shouldn't recommend other
No,
podcasts.
no, you can. Let's do it.
Okay, I
Tell us.
recommend the guys that acquired FM.
Yep.
They did an episode on Amazon, which is like 4 hours long, and they did an episode on AWS specifically, like the cloud side of the business. I think it's a couple hours there. I highly recommend listening to that.
Okay.
Essentially, it's just the infrastructure of the internet, right? Like,
Right.
and there's very high switching costs. Again, like you might notice this trend with Salesforce, ASML, Amazon now. Like I look for high switching costs because I think that's probably one of the most durable moats that there is in the world,
Yes.
right?
I like that you bring up cloud because I think for a lot of let's just break like civilians, like people who don't invest, people think of Amazon and they just think of like Amazon Prime, like delivery and all that kind of stuff, and they forget how much of a conglomerate it is with all kinds of things going on. I don't know that it was you, but I see a lot of tweets about Amazon about how they're growing their ads business really well too. Do you have thoughts on that?
Yeah.
Yeah.
Yeah. So this is what's beautiful about Amazon. Like the retail side of the business, it's a very low margin business in general, right? Like
Mhm.
thankfully they do have the Prime membership with which kind of like makes it a little bit better, like makes it closer to what Costco is. But at the same time, like that entire like being a retailer as a whole, like it's not that great of a business. But then on top of that, because they're a digital company and they're essentially able to similar to like a Meta or a Google or whatever, they're able to sell that digital real estate of like when you type in, for example, a gaming keyboard, the first four listings, you'll notice a little sponsored message right under it. That's essentially the ads business, and that has grown to being bigger than YouTube and Netflix, not combined, but
Wow.
individually, it's
Yeah,
bigger
yeah,
than
yeah.
YouTube and Netflix. I think it's on a $50 billion revenue run rate, and it's growing at about 20%. So
Wow.
yeah. So it's
That's
it's a
very
very
impressive.
yeah, it's a
Yeah.
very big part of the business. Like it's becoming bigger as well. So this is the beautiful thing about Amazon. Over the past couple years, particularly, the highest margin parts of the business are also the fastest growing parts of the business. So you have this natural margin expansion that's going to occur from the core e-commerce growing at about 8%. Meanwhile, the 30% operating margin AWS business, and then you have the 50% operating margin ads business. That's an
Wow.
estimation, by the way. I don't
Mhm.
know exactly, but I'm saying like Meta's at like 43, 45.
Okay,
And
so yeah, reasonable.
I think Amazon has to reinvest less into the business. I think it's easily 50%, right? So you have the two highest margin parts of the business growing significantly faster, maybe like 2.5 times as fast as the slow moving old retailer business.
Mhm. What do you think of the transition to Andy Jassy? Do you like him? He's good? Not too good? What do you
So
think?
this is what's kind of fun about that. I see this on Twitter all the time. People are just like, "Oh, since Jassy took over, this is the day with like a red arrow on the stock price chart," and they're
Yeah.
like, "The stock is down, so he must be a bad CEO." I really don't think of it that way. I think you should look at like when he took over, and this is not like a random guy they hired off the street. He's like
He's the
employee number 10.
AWS. Yeah, right, right.
Like, he's
Yes.
been there. He's the reason why we have AWS today. And
Yeah.
that's a whole nother story, like a very long story of like how he actually became the AWS CEO, and like I believe he was in marketing at one point. Again, it's in the acquired episode if you decide to
Yeah.
check it out after
Yeah.
watching this podcast in its entirety. Um,
Yeah.
so yeah, that's like he's been at the company for a very long time. And if you go back to an interview of Bezos in like 2013, I want to say, Bezos gets asked about the next CEO of Amazon. He's like, do you have any plans of like stepping away? He's like, oh yeah, I already know who I'm going to choose. He's like, oh, could we get the name? Blah blah. In 2013, Bezos knew it was going to be Jassy, right? So it just kind of goes to
Wow.
show that like he's that special of a CEO of a person to Amazon. And I've listened to interviews of Jassy. I've listened to most of the earnings calls. He seems to be knowing what he's doing just based off first impressions and that type of stuff. And then more importantly, the one takeaway that I have from Jassy is like he's not really worried about pleasing Wall Street or any like giving analysts like good answers or any of that type of stuff. Like, he just wants to run the business and he wants to run the business well. He's going to stick to the plan. And I don't know. I kind
Okay.
of like that about him, that he doesn't
Mhm.
really, he's not there to please Wall Street. You know what I mean?
Yeah. 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 I work in PR, so I'll put my PR hat on for 1 second. I would say I do like when a CEO can do both at the same time, like run the business well and also be just good in their communication. But I do agree that if you have to prioritize one thing, it's much better to have a CEO who is a good operator and doesn't speak very well than the other way around. Because there are
Mhm.
too many in the other way around, and that's not good. Like
Yeah, yeah.
smooth talkers who don't know how to run a business, that's very bad. Um, let's go back just quickly. You mentioned and you were speaking very fast, so I don't know if I got that properly, but I think you said if the cloud were to be not good anymore, you would sell. Did you say something like that? No.
Yeah, yeah.
Yeah.
So
Okay. Explain.
listen, if we were to get a situation where for multiple quarters or years in a row, we're seeing essentially Amazon fall behind, and like let's just say the script were to flip, and Microsoft is the 30% market share, and Amazon's market share is consistently dwindling down, right? And they go like
Hmm.
20 or like sub 20. I really doubt that's going to happen just purely based off
Right.
of just switching costs. Like that would some really big things would have to happen for that to happen. But yeah, I mean that would be the reason why I sell out of Amazon. If they're not able to stay competitive in cloud computing, why would I own a declining business? It's that simple for me.
But so my question is that thesis break in? Given that if let's say everything else is still growing, like the ads and everything, you would still sell just based on the cloud performance, if assuming everything else is okay.
Depends where the ads business is. If the ads business is bigger and more important to Amazon at that point, then like if we're talking a decade down the line and
Hmm.
like cloud is, even though I really don't think cloud gets mature for like another like 20, 30 years. Like,
Yes. Agreed.
Bezos famously called it TAM unconstrained, total
Yep.
addressable market unconstrained, which makes sense.
Yes.
Like the world is very big and the world needs internet and infrastructure for that internet. Um, but yeah, like maybe if we're a couple, I don't know, like a decade and a bit down the line and consistent declines in the cloud business, and at that point the ads business is like around on par, maybe a little bit bigger, I think maybe I would shift my focus a little bit more towards that. It really depends, right? Like we could play scenario analysis all day, but it
Mhm.
really depends at the time how things are looking.
Of course, yeah. No, they're very reasonable. Anything else you want to add on Amazon? Or
I just kind of feel bad. I didn't really like explain the cloud too much. Like it just has
it's
amazing
okay. Oh,
switching costs. You know what I
yeah.
mean?
Yeah, people know what the cloud is.
Hopefully.
Okay, good. Let's stick to tech again and go on to Google, which you really like. So for Google, also, I would say most people know what it is, but let's still go through. I guess what are your favorite parts of it, and then after that, I do want to hear your thoughts on their other bets segment.
Yeah, yeah, absolutely. So 70%, let's just do, because I think this is something that most people don't know, is the
Mhm.
revenue share of all the different segments.
Let's do that. Yes.
Yeah. So 70% of revenues is is just the core digital ads that is split between 60-10 of like 60% search ads and 10% ads that are served in like when you go to like the Gmail app and like there's an ad in the corner, or
Mm,
like when you're on Google Maps, sometimes it says, oh, do you want to go to McDonald's drive through on the way? Like
right.
those type of
Yeah.
little ads that makes up about 10%. Banner ads as well, I think, is included in that. Like when you go to like a Wall Street Journal thing and then on the side there's a banner Google ad, that type of stuff. So that's 10%. That part of the business is actually in decline, and it's been in
Okay.
decline for a very long time. So the those are called network ads, all those different things like the Gmail and the that type of stuff. I really don't care about that. It's just a cash cow, whatever. It's going to continuously become smaller and smaller. We're not going to even talk about that from here on. The 60% search ads, that is the majority of the business. It's the most important part of the business. And that's the part of the business that is currently under scrutiny from the DOJ and that type of stuff. I think at the end of the day, like even if they were to split it apart, the business would probably be worth more altogether. Sorry, it would be
Yes,
worth more sum of the
separated,
parts than it is just completely altogether, right? So I'm
100%.
not like too worried about that. The one major complaint I have with Google is there is a good amount of cyclicality in the business purely from ad budgets tightening and loosening up in like soft and good economic times. And 60% ads business, like that's going to weigh in. Like all of a sudden, you'll see like a 30% decline year on year between 2021 and 2022 on the ad side of the business. That's going to impact the fundamentals of the business, but it's a temporary thing. Like if you span out 3, 4, 5 years, you'll notice a pretty decent uptrend going up into the right, right? Maybe we'll touch on the cloud part of the business. It
Hmm.
recently turned profitable. I think it's about 10% operating margins. This is something fun with the AWS example I gave earlier. If Google, at $50 billion of revenue with thousands and thousands of clients, just turned profitable, right? In like literally 4 quarters ago, literally a year ago, after like a decade and a half of being in the cloud market, they just turned profitable, right?
Yep.
Nobody's ever going to catch Amazon.
Yeah. That that's gonna be a big challenge. So that's for cloud. Do you want to talk more about cloud or other bets?
It's gonna. They're just one of the players in there. Something
Yep.
fun about it. I think they have their own TPU chips or whatever. Apparently, that gives them a competitive advantage. I personally
Sorry,
haven't really looked into it.
what is that? I don't know what a TPU chip is. What's
So
that?
like the NVIDIA H100 chips,
Oh,
they have
those.
like a scaled down version of that
Oh,
that is kind of used in similar ways. Apparently, it's good.
okay. So
Yeah,
not a part of the moat, I guess.
yeah.
Um, other bets. What do you? So some people say this is like the game changer stuff that is going to make the stock go parabolic, and others say this is like a money incinerating segment that doesn't need to exist. Where do you sit on that spectrum?
I'm cautiously optimistic.
Okay,
Yeah.
which
So
part?
there's a couple things in there that's like decent. I think they bought DeepMind or something like that. That's included in there. I would assume that's been used to make search more accurate results, right? Like you kind of don't really think of that as like individual things on their own, being able to have like prosperous futures and like big revenue businesses and that type of stuff. But maybe like kind of the stuff that's in there, for example, DeepMind is able to help drive better, more accurate results for the core search business. Like that's kind of how I think of it. Sure, it's cash burning, whatever the case is. It's definitely a lot better than Mark Zuckerberg's Reality Labs, right?
Yes.
I think it's like 2-3 billion per year or something like that they're burning on the Google side compared to Zuckerberg's like 18 billion a year,
Yep.
right? I think in orders of magnitude, it's you could just kind of ignore it, in my opinion. Like it's not too big of a deal. There is Waymo in there, which again I'm cautiously optimistic. It's significantly smaller than Uber as it stands currently, and it's kind of scale constrained in the fact that like they have to map out each individual city. That kind of brings the next question of like, oh, okay, so this will never translate to the suburbs ever. It's only going to work
Right.
within the boundaries of the city, and it's kind of like geo locked. You know what I mean?
Yep.
Compared to like an Uber, which would go anywhere. Um, that's about it. Like I like Waymo, and I kind of just write off the other stuff. I don't really care about it.
Okay, that's fair. And I guess in terms of a buy, Google seems at a pretty reasonable valuation considering growth and moat and all that, right? What do you think?
Absolutely, absolutely. It's like low 20s PE, give or take.
That's very cheap for a business like that.
Very cheap for a business like that, and it's growing in the high teens earnings per share for the next however long. I recently saw an article of like the mid 2010s. So I was like, oh, how much longer can Google's growth go on for? Surely it can't grow at 20% forever. It's grown at 20% for 8 years in a row since that article came out, right? So
Wow.
the world is very big. Let's just say that.
Another thing I like just on discussion of moat, and I think it's so tangible when you look at a Google, let's say just the YouTube segment, right? 'Cause YouTube is owned by Google, is how is an entire economy and thousands of people whose job basically is YouTube, right? That's a huge like when you build your whole career around it.
Yeah.
That's like it shows the how important the business is and how sticky the whole product is, right? What do you
Yeah,
think?
yeah.
You do a lot of YouTube, so you would have an opinion on that, right?
So something cool I was telling my dad about this. Something cool I noticed from a creator perspective, once I started doing YouTube, that's amazing about YouTube is that they'll, for example, they'll get paid by the advertiser that's putting ads on your video, whatever. They'll get paid by them. Let's just say like August 1st, whatever the case is. For the entire duration of August, they're able to put ads on my YouTube video, and then at the end of the month, they'll put like a little payable date, whatever. September 22nd, Aria, we're going to pay you. So just pay attention to the timeline here. Google got paid to put ads, or YouTube got paid to put ads on my video August 1st, and then they pay me late September. And so that creates roughly 45 days of float where they could go
Yeah.
do whatever with that cash.
Yep.
Right? So
Wow. Yeah. And when you multiply that by the billions that they make from YouTube, that's a lot of money.
that's a lot of float they have in the middle there. I would
Yeah.
assume the way it works is in some cases they would the advertisers would even pay ahead. So they would maybe pay sometime in July for the August ads, and then they have to pay me half of that cut in late September. So you have about 2 months worth of float that they get to play around with that and do whatever they want with it, right? So there's like a missed element of float with
Yes.
YouTube compared to I don't know other streaming platforms that just people don't realize, right?
Yeah. No, devil's in the details for sure. Okay. Anything else you want to mention on Google
On YouTube in particular,
or YouTube?
I think I saw a CNBC video of like it accounts for like 50-60% of TV like streaming share. So you'd imagine like, oh yeah, Netflix
Wow.
dominates that, doesn't it? No,
Yeah.
it's like 50-60% YouTube, and then Netflix was a smaller percentage, it was like 20 something percent. So
What
still
do
strong,
we
but
know who is driving that? Like who is watching? Is it more like teenagers, kids, or is it more the millennials? What do you think?
in the video they didn't mention anything about that. I would assume it's mostly older people because I think
Hmm.
like our generation, we'd probably just watch it on our phones, on a computer, laptop.
Yes,
Um,
that's true
but
actually. Yeah,
yeah.
good point. Wow. Okay. You mentioned Uber briefly, and I would love to hear a quick, it doesn't have to be a lot, but I'd love to hear your take on Uber because I know you do like the stock, even if I don't think you own it right now.
No, I owned it very briefly and I set it up front. I'm like, I have no idea if this will be in my portfolio a month from now.
Mhm.
It was like a watcher position. I've since liked the company a little bit more, so I am trying to get back into it. I'm thinking like the low $70 range. I think that's an appropriate valuation. This is like in terms of like my circle of competence when it comes to choosing businesses. This is like kind of pushing the edge of it. My circle of competence is like, like pretty cash generative businesses or soon to be cash generative businesses that like that they've been at that stage for multiple years, and you could kind of measure those cash flows and like project out decent growth. Uber's kind of just for the first time ever becoming profitable, so
Yeah.
it's a little bit earlier in that cycle, if you will. So it's a little bit harder to value that type of stuff. And the reason I like it is I did an hour-long video on this, by the way, so I'm going to try to
Okay. Yeah.
connect it down.
Yeah.
I'm
Yeah. Yeah.
thinking, what are the
And I'll
most
put the
important parts?
link of that in the description too.
Yeah,
Yeah.
there is like a 16% just organic growth rate in terms of users coming onto the platform for the first time. And then within all the users of Uber, there's about like 160, 170 million users that use Uber every single month. Half of those users only buy like, or I guess they only get an Uber ride or like Uber Eats once or twice per month. And so you have this opportunity with Google where you have this like huge install base, essentially, if you will,
Mhm.
of people that are using the app, but are in terms of frequency, they only use it once or twice per month. And so there's a lot of growth that like untapped growth from this cohort of users that you already have that just don't use it enough or like don't use it that frequently. And maybe over time, Uber is able to get them to try out Uber Eats a couple times per month, that type of stuff. And that's a lot of incremental revenue that they don't really have to work as hard for. So that's kind of like very core to the thesis. And it should translate with like, and you're having user count growth for like mid-teens to high teens for the next couple of years and maybe 5 years, whatever the case is. So you have like organic growth of like 16 to 20%. And then any amount of frequency increases on top of that, all of a sudden you're looking at like close to a 30% growth rate business.
That is a pretty compelling case. One thing I'd add to it is I actually used to own Uber. It was a speculative position a long time ago. Obviously, I shouldn't have sold what I sold. I owned it, I think, around $30 or something. So now I regret selling, but that's okay. I like their leadership very much. The Expedia guy, they went from like, I thought the guy before was a bit of a, I don't like the a jackass, but a little bit. I don't know. He was a bit odd, but the new guy, it feels like it became a company for grown-ups. You know what I mean? Like
Yeah,
they are mature, they want to be shareholder friendly, and they're just trying to run the business properly. And I quite like that. It's
yeah,
good to have a bit of the jackass energy at the start because that's, you need the creative people to kind of get the ideas rolling and stuff. But afterwards, when it's time to just again be an adult, it's nice to
yeah.
have an adult CEO. So I like the new guy a lot. I think he's good.
Yeah, yeah, absolutely. I would recommend Dara, the new
Yep.
CEO, coincidentally also Persian, so I
Yep.
have a little bit of personal bias there.
Oh, you're
Uh,
Persian. Okay. Yep.
yeah, yeah, yeah.
Cool.
And no, I would recommend if you haven't looked at Uber in a very long time, I would highly recommend just pull up the financials. You'd be surprised. A lot of things have improved. They do a lot of free cash flow. They're going to do a lot more in free cash flows, and then they've gotten similar to the what's the name, the Salesforce story that we were talking about. In
Mm-hmm.
the past literally 4 quarters, they've improved their stock-based comp situation.
Mm-hmm.
Uber's the exact same way. It's, you could look at it perfectly. It's been flat for the past 4 quarters, and it's probably going to be around there in the future. And so like in literally a year, like the financials of a business could turn around just like that. And so it's a similar case to Uber. I would recommend, if you guys are listening, if you're interested in Uber, pull it up, take a look at the financials.
Incredible. Okay. I have a few rapid fire questions for you. So we spoke briefly about the S&P 500 ETF. I'm curious because your strategy is to beat the S&P. Have you thought of something like a QQQ?
I actually, yeah, I tweeted about this. I'm like, if most of my holdings are going to underperform the QQQ based off what I think, why wouldn't I just buy the QQQ? And I don't know. I'm still kind of undecided on that. I think in the future I will incorporate like a very large percentage of the portfolio as a growth ETF. Maybe not the
Oh,
QQQ.
okay.
I'm
Yeah.
thinking SCHG. I really
Yes.
like
Oh,
that
yeah.
one.
That's a good one. Yeah, man.
Yeah,
Yeah. Okay.
I like that one. I like the healthcare tilt in that, and I don't know anything about healthcare, so I'd like to own some healthcare in like an ETF format. So yeah, in the future I'll
Yeah.
probably do that.
Cool. I can tell you, man. I don't know at all your situation with how many accounts you have or how you structure them. I can tell you for my personal situation, I have a TFSA. Well, I have a few of them, but the main one is where I'm most active. I'm trying to be less and less active over time, but I still am. That's where I hold most of my individual stocks. But then my RRSP stuff, it's only ETFs in there, and there's something peace of mind, about you put some money in there and you don't even think about it and it's growing and you don't have to, right? So I have the S&P and world ETF, but I'm always thinking about stuff like QQQ because at my age I'm still comparatively young, right? If
Mhm.
I, give it 40 years, it's probably going to do pretty well. So, and I don't have to think about it. So that's,
Yeah, yeah,
yeah,
absolutely.
food for
Yeah,
thought.
exact same way, right?
Yeah. Okay. International stocks. So actually, you own a couple. You own ASML, which is Europe, Dutch. Do you own any Asian? You don't, right?
No, no,
Had you ever considered it? Do you like Asia?
not really. I mean, no.
No, not
Uh,
really. Nothing in there that,
like for reference, I have like 5 stocks in
right?
my portfolio, right? Like,
Yeah.
it's not. Yeah,
So a lot of people who buy American stocks say that it's American, but really they're global, like they're global, like Coca-Cola is like everywhere, right? Is that
yeah.
kind of how you view it a little bit, I guess?
Yeah, I guess so. Like I do think of it that way. I mean, the only most of them have a very big American tilt. So, or like North American tilt. Like
Yeah.
CRN is like mostly in North America, a little bit
Yeah.
in Britain, that type of stuff. Amazon mostly AWS businesses all over the place, but
Yeah.
the e-commerce and that type of stuff, right? I guess Google's the only like really global. Google and Mastercard are like the really global businesses that I own. I really don't care about being global or any of that. Like
Hmm.
that's not, that's maybe the 20th or 30th factor I look at when I'm trying to make an investment. I
Yeah.
don't care
Yeah.
about that too much.
Okay. No, that's very fair. Um, just I'm curious, what have been some like I guess your worst investment ever and your best investment ever? I like to ask everyone that.
Technically Tesla, right? Because I rode that one. I had an average cost of above 300, and
Okay.
I rode that one down to $100 a share. And I'm talking split adjusted, right? But then
Yeah.
I was at the time I was still believing in it, so I did dollar cost average down. I got out at about 260, and my average cost was like 254, something like that, right? Give or take. So technically, that is the worst investment. But at the end of the day, I got out at break even because I was very iron willed.
Yeah.
But in terms of actual realized losses, you'd be surprised. The biggest realized loss I've taken is 10% on PayPal,
Okay, that's not
like
even that
recently.
bad.
not
Yeah.
bad at all, right?
Yeah.
But unrealized, I was down 70% on Tesla at one point,
Wow.
but I held through it.
Yeah. Ah, man, I got one like that. I was down 70% on kits, which I think I recommended to you. Well, I don't recommend, but I brought up. I was down 70%. Now I'm up around 60%. So I held through and I didn't even average down. I literally left it because I was like, this is a good business. I should have averaged down, but we all make mistakes, right? Um, okay. Do you still want me to give you a small elevator pitch on Brookfield? Because I can do that in a few minutes if you'd
100%.
like.
Let's do it.
Yeah. Okay. So you've already, I think you started looking into it a little bit, right? But to give you, I guess, very quick history, right? They started out as an industrial conglomerate. So really, it's a business that owned a bunch of stuff that had nothing to do with each other. They were in mining, they owned utilities, pipelines, all kinds of stuff, but it was most of them were they call them real assets, right? So it wasn't like software, it was like actual things and real estate too, okay? And then they had 100 years of experience of doing this kind of stuff. They had a lot of restructurings, all kind, different ownerships, things like that. And then at some point they said, okay, you know what? We've done this for 100 years and we're pretty good at it, but there's a way that we could make even more money. And that would be if we use the same skills we already do, but we get paid to do it by large institutions. So sovereign wealth funds of countries or pension, plans or what, all this kind of stuff, right? So they started knocking the door at institutional investors and saying, hey, give us, 10, 20 million, whatever. We'll just put it in a fund and we will partner because we'll use our own money too, but we'll combine your money with ours to buy more large assets and we'll earn a performance fee when we sell, right? So a carried interest is what we call in private equity, but we'll also earn a management fee. So an annual fee, 1.5, 2%, whatever on the amount that was given to them. And supercharge the returns that way, right? So that differentiates them a little bit in that a lot of private equity businesses, they are only asset light, so they don't put up their own money. So most of the private equity is a background of they just go to other companies and ask for their money and then they invest it, but they don't have their own. Whereas Brookfield came from they were already doing it with their own money and then they started combining it with others. But what they did very recently, it was like 2 years ago, is they actually split. That's what you'll see. They have millions of tickers. So BN, Brookfield Corporation, now is the top of the pyramid. They own 72% of Brookfield Asset Management now, which is the asset light private equity asset manager business. So Brookfield Asset Management has zero debt. They have, I think, 2 billion cash on hand. And they're the ones that take the money from the institutional investors and they manage it. And they also take money from BN. And BN gets distributions from Brookfield Asset Management and other subsidiaries that they have. So Brookfield Renewable, Brookfield Infrastructure, Brookfield Business Partners. So they just pay dividends. Brookfield Corporation also owns their real estate segment. It used to be a subsidiary, but they privatized it during COVID when REITs fell 60, 70%. So they thought, oh, great time to just buy all of it. So they did that. They also own an insurance segment. It's called Brookfield Wealth Solutions now that they started 2 or 3 years ago, that they're scaling very, very fast. And so, yeah, Brookfield Corporation now, it's literally just, I call it like my mini sovereign wealth fund. All they do is get distributions from all the subsidiaries, and then they reallocate it, whether it's buybacks, whether it's dividends, whether it's taking that money and just giving it to the asset manager to manage to be part of the funds that they have. And it's that simple. Now, the moat, some people would say private equity doesn't have a moat. It's kind of true, but they have track record, which is very, very important. If you go, let's say, they have every year there's these like climate change meetings between all the countries and stuff, right? So they had one in the UAE recently,
Yeah.
and the UAE just pledged like $30 billion to stuff like that. And it's going to Brookfield and to BlackRock. Those are the only two, right? It's so when you have track record and everyone knows about you, all those pension funds and sovereign wealth funds, they're not even necessarily going for who's the best private equity manager, although I would argue that Brookfield is also very good, but they are just going for who is the most known and reliable and who they know, is not going to mess around and make big mistakes. And that's for the Western world, that's Brookfield, BlackRock, and Blackstone, and maybe also KKR and Apollo and a couple others. But that's really it. It's a very small group. And then the other part of the moat is that as they grow bigger and bigger, the amount of deals that they can do, there's very few. So if you have $10 million and you want to buy an asset, you get lots of competition because a lot of people can get $10 million. But when you have a $10 billion fund and you want to buy a business outright, there's only like two or three in the world in that space that do stuff like that, right? So the competition is less. The absolute amounts of money that they make is getting larger and larger, and the growth has been phenomenal. So when I started investing in 2019, they had $400 billion in assets under management. Now they're at $1 trillion. In 5 years, they more than doubled. They think in 5 years they'll be at more than 2 trillion. Yeah. And now here's the cool part. And this is why a lot of people are asking me, oh, should I buy Brookfield now? And I say, I don't know, because it's still a decent valuation. But last year, man, it was trading at 10 times DE. So DE, but I should have explained, DE is their metric for free cash flow. Basically, it's the distributions that they get from all the subsidiaries. They have very little capital costs for any of their stuff. So really, when they get the DE, they just do whatever they want with it, right? So I wouldn't look at PE ratio because that number is all over the place because they have their real estate. So there's a lot of intangible accounting metrics that might make the PE look high or low depending on what happened in the quarter, right? But within DE, there are two types. There's DE before realizations and DE after. So I would say if you want to be conservative, take the DE before realizations because those are the recurring distributions, let's say, and the DE after realizations is when, for instance, in one of their funds, they make a sale at a profit. So all of a sudden, there's an extra 500 million that they earned that quarter. And honestly, there's DE after realizations in literally every quarter, but you shouldn't always necessarily count on it. To give you one example, in the last quarter, they actually sold a small piece of their Brookfield asset management shares. They use it as a currency to buy other things. So they sold it so that they could buy another company that to spruce up their wealth solutions business. So all of a sudden, I think they made an extra 900 million in DE, but that was just them selling their ownership, right? So you shouldn't count on that all the time. But yeah, man, it's a very, very powerful and strong business. The CEO has been there. He was number two, I think, best accountant in Manitoba when he was like 20. Like he went to accounting school and he did like this big provincial exam or whatever. He was great. So he was in his early 20s. He got hired by Jack Cockwell, who was the Brookfield guy before they were called Brookfield. He worked 10 years with them, and then they made him CEO of Brookfield Properties, and then eventually became CEO of Brookfield Corporation or Asset Management. The business is very much made in his image. They're pretty low key compared to the private equity industry. And they are long-term focus. Sometimes they'll do stuff when you're kind of like, why are you guys, doing that? Like contrarian picks, but they are very much doing it because they are looking at the next 10 years. So during COVID, they bought so many assets that people are like, why are you buying these assets? And now they're selling it, 30% internal rate of return and all this kind of stuff. So yeah, I love them, and I could put 100% of my capital in it. I mean, I would never do that, but I would be comfortable with that. And it's my largest holding now, mostly because it's grown a lot. I also bought a lot before, but it's grown a lot too. So
amazing.
So that's the elevator pitch. Yeah.
Amazing.
In a few minutes.
So, and I'm sure you get this comparison all the time.
Yep.
Is it a little bit Berkshire Hathaway?
Yes. The one difference though is the asset management component, right? Which is what supercharged it. Is that Berkshire, they're not really a private equity business. They're just like an industrial conglomerate. They just own a bunch of stuff, and they have a big equity portfolio. Brookfield doesn't have a very big equity portfolio, but they have a lot of real assets, right?
Yeah.
So it's a little different, but they are similar in that they have this, long-term focus, very value-oriented, a little old school, and I mean, Bruce Flatt, who's the CEO, he's often referred to as the Warren Buffett of Canada. So it's certainly a comparison, that they get a lot and that they like. So yeah.
Amazing. It definitely piques my interest, though. Doing my homework on that.
And another thing too is this thing about separating the corp and the asset manager. It's been such a game changer in that, again, it's this whole sum of the parts thing, right? Where before, most analysts, they hated it because it's like, how do you value a business that's an asset manager and does all this other stuff at the same time? So, suffered from the conglomerate discount. It was always trading at way below intrinsic value. Since they separated, it's helped a lot, and it's still, according to their personal projections, they say they're still undervalued. Sometimes I would take their projections with a grain of salt, and I say that with all the love I have for them, right? That's the part where a lot of bears on Brookfield and the industry in general will say they are overly promotional and all this stuff. I think sometimes it rings a little true, but I do appreciate that, they do encourage people to say, like, listen, you should look at Brookfield as, again, like the Berkshire comparisons. When Warren says, buy a farm, and you don't think every day, what does the farm trade at on the stock market, right? You just have a farm and it gives you, your crops and your free cash flow, whatever. And then maybe in 30 years, you want to sell it or give it to your kids. And so Bruce Flatt very much encourages people to look at Brookfield in that way, where you shouldn't focus on the stock price every 5 seconds. You should just look at the DE that they generate over time. And certainly the compound growth of the DE, it's in the high teens. And it's been like that for many, many years. And the stock compound growth, they actually, in their investor day a couple months ago, they started off, I've never seen them do that before, such a flex, is they showed Amazon and I think Walmart and Google and a lot of others. And they said, yeah, over the last 20, 30 years, they actually outperformed, which is quite impressive. Yeah, I know. It's like 18% compounded growth in the stock price over the last 30 years. So yeah, it's and that's with them saying they're trading under intrinsic value still. So yeah, it's a pretty cool business. I would not start a position right now unless I knew that I would hold it for a very long time. Just because, valuation wise, it's still a decent buy, but it's not like, punch in the air, this is the best buy ever buy. So yeah.
That makes sense. Just because I can't really find the numbers, what is the multiple on it on DE?
So there's before and after realizations, right? Now, I think on the before it's closer to 20, maybe 18, 19, and after it's like 15. So it's still an okay buy, but again, I'm telling you, man, the full of 2023, it was like at 10 and under, which was insane for a business like that. It was crazy.
I should have.
That's when
You
I
should have
bought
told me about it
tons.
then.
Yeah, I didn't know you back then. I wish I did, but yeah. So that's when I like bought tons of it, and now I don't know what to do. And also, so I have different accounts. I also have a non-registered account because I'd maxed out my TFSA. So now it's like I don't even want to sell because taxes. So I'm just gonna let it. And actually, this is just one fun random thing. I don't know if you have a non-registered account, but it's actually been my best performing account because I haven't been active on it because I don't want to trigger any taxes, which is crazy. And my portfolio there is just like Brookfield Corporation, Brookfield Asset Management, EQB, and Quebecor. That's it. It's just crazy. So yeah.
Amazing. It goes to show, right? This is kind of what I'm recently moving towards. Like I've purged my
Yep.
portfolio twice.
Mm-hmm. Yeah.
Like I really this time around, I'm not going to be touching any of the companies I own. Kind of the
Yep.
reason why I have only 5 holdings. Like
Yep.
I know with full confidence I'm not going to touch any of them unless something like super drastic happens, right? But
Yep. Yep.
I really don't foresee that type of a future for any of them.
Yeah,
But
man. I can tell you if we hold our good stocks for a long time, good things can happen. For me, it's just been just over 5 years now that I've invested. And a bit like you, I made a bunch of mistakes at the beginning. I bought all kinds of stupid stuff. But now as I, cut down the size of my portfolio and have more and more core holdings, those are the ones that I'm like, yeah, I will hold this for a long time. And hopefully I also give them to my kids. But yeah, it's quite exciting. Cool stuff. Okay, man. Are there any closing thoughts you want to add? Maybe some advice for new investors for our listeners?
I was just going to say we forgot to do some of the parts valuation for Amazon all the way back.
Oh, let's do that. Yes, give us that, and then yes, and then we
Okay,
close it off.
and then we close it off here. I would like to assign, and this is like if you look at where Microsoft is, right? It's trading at about 12 times price to sales. It's essentially a pure software business. I think that a similar valuation is appropriate for the AWS side of things. So AWS side of things does about 100 billion in revenue. If you put a decently fair 12 times price to sales on that, you land at 1.2 trillion market cap.
Wow.
Amazon today trades at like 1.8, 1.9.
Oh
So,
my God. Yeah.
okay, so you see where I'm going with this.
Yeah.
The other give or take 600-700 billion market cap of Amazon is the entire e-commerce business, which does about the same amount in revenue. I think it does like 500 billion in revenue, some crazy, right? You have the ads business in there, which we just mentioned is a 50% operating margin business with 50 billion revenue run rates. Again, if you want to do like a one-to-one comparison with something like Meta, I would assume even if we chuck like, I don't know, like a 20 times multiple on that, so that'd be like 25 times 20, you're looking at like 400, at least like 400 billion in market cap just for the ads business. So you have
Yeah.
1.2 and 400 billion for the for the two most important parts of the business, the ads and the thing. So then you're left with like 200, 300 billion for the e-commerce and the Prime subscription and everything else in Amazon, right? So all of a sudden, like if you do like a sum of the parts valuation, it's definitely not that expensive.
Undervalued. Yeah,
Yeah,
it's undervalued for sure.
yeah.
That's even at the, off the, it's had a bit of a run up in last year or so, but even still, it's still probably a buy.
It's still probably undervalued, give or take 30-ish
Yeah.
percent. Yeah,
Wow.
that's kind of how I think about that.
Cool. All right, man. Well, thank you for that. Again, do you have a word of advice for young new investors?
I would just skip the stock picking thing. I say this from the bottom of my heart. I just
Yeah.
wish I myself, actually, I guess the lessons learned along the way is kind of worth it.
Yes.
Um, but if your goal is purely for money, just making money, I would just skip all the stock picking stuff and I would 100% go into ETFs. And then
Mm,
over time, you could maybe start incorporating as you learn more about analyzing businesses, maybe incorporate like 10% of your portfolio into individual picks. You're like, you know what, I really like Brookfield Asset Management.
mhm.
Newcomer Investor. I've been watching his podcast. It's amazing. I like this company, and then let's do like 10% of the portfolio into that. But I would 100% start with ETFs, either the S&P or if you want a little bit more aggressive, something like a growth ETF like SCHG or a QQQ, something like that. That works fine, and you have way less risk, and you're less prone to buy and sell it constantly because it's an ETF, right? So that's advice to newer investors. I definitely do that.
I love that. And even though we don't give advice, I fully endorse this. If I were to go back and start again, I would do exactly what you described. Except I
Yeah.
would put maybe 25% individual stocks. I still love individual stocks, but 75% ETF. And it would be just a world ETF, like with a major tilt on US, Canada, but with a bit of Europe and Asia. Just
Yeah,
set it and forget it and
yeah,
don't think about it. Cool,
absolutely.
man. Last thing is, can you give a shout out to your YouTube channel and your Twitter? Like, what do we follow you at?
Yeah, so it's quality investing with Aria, and Aria spelled with an I. My handle on Twitter is quality invest 5. Same thing on YouTube. I do essentially just stock analysis on companies. So if you kind of like the podcast here, like I just do like a longer version of that, more detailed version of that, probably over on the YouTube. That's about it. Yeah.
Perfect. Thank you, man. So happy to have you on the podcast. And I'm glad we got to do this. And yeah, for everyone listening, thank you for listening to the Newcomer Investor Channel. Don't forget to give us a 5-star on the podcast. And we look forward to connecting again with you soon.